because when you go through some of these candles and try to average out what has kind of been the average daily range, it comes in 6 cents, 8 cents, whatever it is. So 6 cents is a bit of an arbitrary selection, simply because we need to start somewhere, and we need to figure out an amount where we're limiting our risk. 6 cents in corn would be times $50 a cent would be $300. So you can be comfortable perhaps trading that amount. So in this particular case, we had a predicted low of 389, and that means that we would be short at roughly 383, which would be somewhere right in here. I don't know if I have it at precisely the right point, but you get the idea that you would trade on the breakout of the predicted low minus that 6 cents, and then you would be short the market, at least for the time being. That's subject to change, and the market does indeed go down, and so you have a good short trade. Now, we aren't expecting a humongous move in corn, simply because the prices are still in a kind of a state of flux. It's too early to get really bearish. It's also, you don't really because of the conditions, you don't want to be too bullish. So we're expecting at least somewhat of a move, but not a huge move. Then we come into the predicted highs here. Starts to play a factor. We have our stops above the predicted highs, and as the market moves on down, on June the 8th, we had a predicted high of 361, so that means we would have a stop at 367. And it does get filled. It takes a little bit of time, but it does get filled somewhere right in here where it would take you out of the market. Now, we said we were in the primary downtrend, so therefore we do not necessarily want to take a long position, because we aren't real optimistic that we're going to be able to trade a long position for very long, because there may not be that much of a bounce. But we do expect the market to be under pressure because of the situation that we have from the fundamentals. On June the 10th, we did have a report. This longer white candle here is where we would have gotten out. That report was due to the fact that we had a USDA crop production report that date, but it was only for wheat. There's always some possibility that there would be some effect on corn because the markets are closely related, as I mentioned. So you can expect that there might have been some type of reaction, but it's not the dramatic type of reaction that you would expect if the report were only to affect corn. Let's take out a couple of these. And so we're looking for our next opportunity based upon what we think right now, our next opportunity to be short, and that would have occurred in this particular spot right here, where we had on June 21st predicted low of 376, giving our 6 cents leeway there. That would get us short at 370, and so we would be short approximately right in this vicinity right here, 370. The market would be on its way down. Now, the next thing we have to do is look at the various indicators. You can see by the screen we have the predicted differences going down. We have the Neuro Index is at 0. The predicted moving average is turning over. It is moving down. So it looks pretty bearish all the way coming down here as we're looking at the situation coming into the key report that we're going to be dealing with, that we had to deal with on yesterday on June the 30th. Keep in mind that as you were looking at this, we're also keeping an eye, on some of the traditional technical analysis things, because traditionally, that's what most people are following. They aren't necessarily following all the predicted highs and lows like we are on Vantage Point. So you need to be aware of what the traditional technical analysis people are looking at, and they're probably looking at this low that we had here. It goes back all the way to last fall. It's a little bit below the lows of last fall, but essentially looking at a low that could be reached at around 345, the previous low. So we're at that point. Now it's decision time. We are at June 29th. We're assuming we're going to be at June 29th. Excuse me. And we have to decide, what are we going to do after we have seen this little profit, June 29th, we're right there. What are we going to do with the crop report coming up, knowing that crop reports can be big surprises? But we really have about 3 different choices. You could say on June 30th you would use the predicted high kind of as your point to get out. The predicted high was on that day was 350, and so that would have gotten you out, if you were looking at it just strictly from the indicator and the standard, just the general type of thing at 356 or somewhere right in there. But if you know crop reports and if you know how things happen, you would have been short and you would not even have had a chance to get filled until somewhere in the vicinity, probably even near the top end of this candle, somewhere way up there. So that would have been kind of a big slippage issue and another loss that you would have suffered. Now, the second thing you could have done is that as the market moved down and as it was slumping and starting to skid and getting towards that low, you could have taken some profits. And I don't know what it is that you might have done, but remember we said that we were going to be in at 370. We're short at 370, so if we just want to use a nice round number, we can say, well, we'll get out at 350 and take our 20 cents, that's a $1,000 gain, and kind of write out the crop report. Wait till we see what does the market say, what do they want to do with the crop. So then we would potentially be out and just waiting for the next short clue. But the other thing is, if you do have a short position and you do feel that this is the correct position for the longer term, and that would certainly make a case for that, and then you might want to buy a call as insurance in case of a surprise, because as you know, we often have surprises in crop reports. Why they occur, why USDA comes up with those, sometimes kind of hard to fathom, but it's a reality of trading. And so that's kind of how, in looking at the whole situation in corn, you might have approached the USDA crop report numbers that we were talking about. Okay, now we want to take a look at the Vantage Point screen again, talk about a few other different types of markets. We talked about corn. Let's just make a quick glance here at soybeans before we get into the S&P E-mini. And as you know, soybeans and corn are closely related. This is a 2-month chart of soybeans. Because it's a closely related market, sometimes you have a situation, as you can guess, if there's more corn, or less corn acres rather, there's likely to be more soybean acres because it's kind of a trade-off in acreage, which is what did occur. And so what may be quite bullish for corn may be dampened by the fact that it could be a little bearish for soybeans. And so you always have to be aware of what's going on in these other markets. In fact, the wheat figures that I saw looked to me like they should be a little bearish, but wheat also went up. Wheat supported corn, so corn kind of ruled the day for this particular report. But when we're looking at what was going on in soybeans, if you wanted to trade that market and not necessarily trade the corn market, you might have looked at this predicted low that we had here on this black candle. This was on June 23rd, where the predicted low was 931. I would use a 10-cent leeway here on the on this particular market because soybeans tend to move